Training video 29, spotting a strong bearish death cross. I'm Matt Shaw, Chief Analyst, Knightsbridge Trading Academy. Now, quick example here on the Euro Pound. Pretty much, I don't know if you can see this first off, but what's known in the industry as a death cross is simply, it's pretty much a bearish cross is what it's known as. The shorter term moving average on a chart crossing down through the longer term moving averages. Now this could be a medium term moving average or a much longer term moving average. Now as you can see here, the red moving average is quite obviously the shorter term moving average here. It's reacting a lot more to shorter term price movements, and in this case it's a daily chart, so with the daily candles it's moving a lot more, and the shapes are changing a lot more regular. The medium term, the blue, just seeping through the chart there, and as you can see, the yellow, the longer term moving average, is just waving through the chart nice and gently, and it's an overall very good guide for a very much more of a longer term median of this price action. So what have we got here? Quite simple. On Euro Pound, this is an example from August 2013. I actually remember this period. I was trading in my old office, and through the summer I had not long got back off holiday, and yeah, I do remember this kind of move. It happened on a few markets, and a death cross was seen, specifically a good one on Euro Pound. Now I do like the longer term time frames for these. You can trade this on any time frame. Obviously the longer term time frames for these, I feel they're a lot stronger. I've traded them sometimes on a 15-minute chart, a 30-minute chart. I'll go through some examples now, but this is on a daily chart, and you can see right here the cross came where pretty much the market sold off here, right from a high of above 87.58, and the market sold off down to support of the longer term moving average. But when it done this, when it sold off, the actual shorter term moving average didn't actually cross. It headed lower, but it didn't cross the longer term moving average, did it? See, it just about nipped it here, and then carried on for a few more days. And then look, the market peaked up. The shorter term moving average just about started to gap away from the blue medium term one, and then it was only until the market gapped lower below 85 was where there was that significant cross of the medium term, but the actual signal was when it crossed the longer term one right here. So that was where your real signal came in around 84.50 right here, 84.50, and then the market seeped lower down to 83, actually came back up to 85.75. You would have got out after 50, 80 pips, 100 pips anyway, and the market sold off 150 pips after it actually crossed. So you're not looking for really any more than that. And as I said, we've got before, we actually start moving our stop losses down lower when you're selling, so then eventually you may get stopped out 20 pips, but you've already bagged 70, 80 pips. And then eventually it made that secondary lower high, if you're sloping channel forming here, and then sold off some more, and again made another lower high and carried on lower. So these death crosses, what they're known as, can be the start of sort of a new wave in the chart, and technically where it's due for a lot of downturn and sloping trend line price action, where the markets will sell off, rally back to lower highs, hit a point, come back, and then so on and so forth. And that's what Euro Pound typically did later on into 2013, all stemming from that one death cross there. So let's go over to let's stay on this actually, and let's go forward to 2015. Again, late 14 is an example there, where the market continued lower and then sold off some more. But we'll go back to again this period here. Actually, it's gone walkabouts. Again, perfect example in September 15, and that is pretty much where Euro Pound here again made a low around 69. I can't believe Euro Pound was actually that price. It seems such long ago, doesn't it? And then the market made a short-term high, but what happened? It started to sell off, but again, it took a few days for this moving average to catch up, because don't forget, it's a lag at the end of the day. The moving average follows short-term price movements, and it factors in all the previous price action. So this is an average, a daily average, and this is a specific moving average forming of so many days for this moving average. Now it sold off, and look, it only crossed there, and it was a triple whammy because then it crossed all two of them at the same time. So it was a perfect blend of where it crossed three, well, where three moving averages were all interlinked. So where the shorter term one was crossing the other two, the medium one and the longer term one, around about this price here, 72, pretty much 72. I'm actually crossed it at 72.55, but the price had already dropped to just below 72. So that was really your entry, just below 72. There were certain things we'd look at there of timing and just waiting for something to happen or not to happen, and then it carried on lower and headed down towards that 69.70 level, 69.80. So then a good 200, 230, 240 pips of that selling from there. Yes, it initially topped out here, but when you're here, and this is what trading is all about, you don't know what it's going to do at 74.50 or 74 here. This could have just come back to this moving average and carried on higher to 76, because eventually that's what it did. But this is what trading is: selecting carefully your timings and your entries for particular price periods. It just so happens this was due for a sell-off here. It had already sold off 200 pips pretty much by the time we were given a signal. But that signal was showing something potentially, the continuation and momentum was in that direction, and it carried on another 200 pips. And this is the part where we capitalize, because we've factored all this in. This builds the trade, gives us the energy and the foundation for the signal. It's activated right here where the moving average crosses over, the death cross occurs, and then it carries on lower. And then you're out well before this. You may have got stopped out on the way back up if you lowered your stop losses to within 20, 30 pips of the price. So that is a good example. One last example of this, we'll go on to, shall we go on to pound dollar? It only seems fit in really. And again, very similar. Here we've got in August 2015, again, where the market was, again, sort of made a head and shoulders up here, and made a high above 158 towards 159, and then made a lower high. But look what happened here. Now this is crucial in terms of timing. The market sold off, again, sold off quite harshly here in these 2 days, but the moving average was still above the medium term one. It was only until the 4th day and into the 5th where the short term moving average crossed over the longer term one. And that was your signal to get in. Certain things had to be applied on the day, certain amount had to be down below. We always have to be, what I tell my students and what Knightsbridge always says, the candle, the price must always be a specific amount below these moving averages before you even think about getting in. And certain things, certain timings and certain shorter term price movements, because then when we look at this on a daily, we also then assess the 15, 30 minute and 1 hour to make sure certain things are happening, to make sure we're comfortable getting in, and the shorter term price movements complement this longer term chart, this daily chart. Pretty simple. It then closed off, it bottomed out here, came back, made a lower high, and then sold off some more. But even then, you still would have been happy getting in here and getting out below 150, 130. That was still well over 200 pips when this actually crossed over. So you still had plenty of gap there and margin to get in, profit, and then get out somewhere here. So absolutely fine. And then you could have done the same thing on the way down, as this then clearly became a sloping bearish trend, pretty much similar to a descending triangle. The base here and the triangle forming there, not a complete one, but very similar. And the market then went on to make lower highs continuously and then completely drop off and die a death early in the new year. Very similar. So pretty much that is the bearish death cross. Very simple indicator, can be used on shorter term price charts, but I do like it looking at the 1 hour, 4 hour and daily. When I get the confirmation, I then look back on the shorter term time frames for price confirmation on that day that helps me with my entry point. Thank you very much, guys. On to the next video.